Most weeks and months, I make money trading, not because I guess, not because I follow someone else's signals, and not because I'm lucky, because I know where the money is rotating in the market. I know which stocks to choose and which ones are going to give me the biggest moves, all by following simple strategy using price action and volume. And in this video, I'm going to show you exactly how you could do the same. Whether you're brand new or still inconsistent from trading, I'm going to show you the exact processes I use to find the best setups and read price action and candlesticks to profit within the markets. This is the exact blueprint that took me from an unprofitable trader to someone who's now able to make over 7 figures every single year trading options. The lessons I'm going to share in these 3 episodes of the Back to Basics series is basically a compilation of what I wish someone showed me when I first started trading, specifically following technical analysis and becoming a beast on the charts. The first step to finding high probability trades is finding the right sectors and the themes within the market. What this means is a lot of times during the market cycles, there's different themes and there's different sectors that are going to be very strong. For example, in 2024, there was the AI bull run with stocks like Nvidia, AMD, SMCI. These are the stocks that led the markets higher and that gave you the best returns. It's called the true market leader. These are the narratives, these are the themes that continue to lead higher, and it's usually some sort of innovation. Something like aerospace stocks now, quantum stocks. These are stocks that are starting to lead the markets higher. This is new innovation in the United States, especially since the 2000s. These are the stocks that have been leading the markets higher. Anything that is going to change the future and that is early are going to be the leaders and the themes that are going to move us higher. The reason why it's so important to identify these is because if you trade something that's coming off of like 52-week lows, you're probably going to make way less money than a stock that's making new highs because 1, there's much less resistance for the stock when it's making new highs. 2, it's the market leader, so everyone is trying to get into that stock. And 3, there's typically going to be a theme or a narrative for that stock, which is why it continues to move up. So for example, another theme like the AI theme. So artificial intelligence is probably going to be huge in the next 5 to 10 years. Everyone is buying into the artificial intelligence craze. I'm going to show you exactly how to find these sectors and these themes and how to kind of navigate through and see which ones are the ones that are leading, the ones that are emerging. So the first thing you want to do is pull up finviz.com. Then you want to head over to the groups tab. This is going to show you how a lot of these sectors have been performing over the last day, 1 week, 1 month, and it goes all the way down to the year-to-date performance. Now, I love this website because it helps you visualize how much the sector has moved. So you could see, for example, right here, technology stocks were up a lot today. And then on the 1 week, they were also leading up about 16%. And then if you compare it to the 3-month, you can see on the 3-month, these are actually still down about 2% from the highs. But what I usually like to do is look for the sector that is leading over the last 3 months, 1 week, and 1 day. This is the most important because these are the sectors that are super strong. Maybe a year ago, the technology sector wasn't that strong, but if it's strong over the last few months, it's clearly starting to lead and it might emerge again as a new leader. So for example, here you could see a few sectors that are showing up. We have the tech sector and the consumer cyclical sectors. These are the top 2 for basically the weekly, the 1-month performance, and the 1-day performances. So now that we know which sector is the one that's leading the markets higher over the last few months and weeks, we can click on that sector. So we'll click on the technology sector and then we'll pull up about 700 stocks for us. Now, I like to narrow this down by using a screener and some parameters. That way I'm able to find only the best stocks in the market. So what I like to do is put the market cap to over $2 billion. This is going to show me stocks that aren't too small cap to trade. I'm also going to want to put the price to over $3. This is not going to give me, again, these small companies that I don't really want to trade. The average volume should be over 500K so that we have enough liquidity. And then I like to have the relative volume over 1. What this is going to do is show me the stocks that have had the highest relative volume. Now from there, you could see our search is actually narrowed down to 113 stocks. And these should be 113 stocks in the best sector that are acting the best and that have the best liquidity. So for example, you can go in here and you can start finding some of these setups. And as we talk about the price action and exactly what to look for within these setups, you're going to understand exactly why you can pick some of these and make a ton of money. So the first one that I see right here, another really good setup, Affirm. From there, you could pull this stock up on TradingView and then you could see if there's some sort of setup setting up on it. But as we dive deeper into the video, you'll understand exactly what I look for in the price action. The next thing you could do is head over to tradingview.com. Then you can go to markets right here, stocks, and then sectors and industries. This is another way to view sectors and industries within the market. Now, there's overall about 20 sectors within the market, but there's more industries within those sectors. So whenever you kind of dive deep into the sectors, you want to really get into the industries that are leading the sector higher. So what I like to do is see which sector has been the strongest over the last week or so. So you can go right here and do the same exact thing. So right off the bat, you can see consumer durables, electronic technology, and producer manufacturing were some of the strongest sectors. So I'm going to click on electronic technology. And then from there, again, you have 344 stocks. But we can actually narrow this down by the industry, right? We could see which industry has performed the best. So for example, you see we have 9 industries within the tech sector. Now we can narrow it down by the ones that had the best performance. So for example, on the day today, the semiconductor stocks were performing the best. So they're clearly some of the leaders. So we'll click on semiconductors. Now that narrows it down to only 100 stocks and a subcategory within the sectors that are clearly leading the markets higher. Again, this is going to be like the AI, artificial intelligence type of theme and momentum that these stocks have. And now we can actually find the leaders within this industry. So you see what we're kind of doing is narrowing it down to the leaders of the sector, the leader of the industry, the theme, and then really down to the strongest names in that theme and that sector. So from there, I like to sort it by volume. This is going to give me the stocks that are the most liquid. And then we can go through and look at some of these stocks and see if they have some really good setups. So you can see Nvidia, Wolf, AMD, INTC. These could be some stocks that are starting to emerge and potentially leading the semiconductor sector higher. This is a move that Nvidia made on the weekly time frame. You could see it made an absolutely huge move up. This was in 2024. And you could see how it was the leader of the markets. It was just leading the markets higher, continued to make new highs. It based and then broke out right here. Base broke out until obviously it started to hit a little bit of resistance. But now as it continues to lead up, now it could potentially lead the markets into new highs again. The last thing you want to look out for is the macro analysis within the market. So you want to understand which themes are strong, where the hype is. For example, robo-taxi is a big theme that's coming up. Tesla's having an event for robo-taxis. Uber's another company that's very big on autonomous cars. These are themes that are going to continue to kind of make themselves known, and you want to be able to trade them, and you want to be early, right? We don't want to be too late to the theme. That's usually when a lot of retail gets trapped. You also kind of want to understand that earnings could be very big for companies as well. These are catalysts that we could look for to really propel some stocks higher. For example, if a sector has super strong earnings, like semiconductors, like the AI hype, we could start seeing a prolonged move within that theme, within that sector. So these are things we should be looking out for. You always want to keep an eye on which sectors are strong, which theme has been leading the markets higher, that theme's earnings as well. That gives you a better kind of idea and more context into how strong that theme actually is. Now that I know how to find really strong stocks, I'm looking for a story on the chart, and I'm looking to actually understand what the chart is doing and what the stock is doing. This is called price action, and behind price action, there's these candlesticks. So if you look at this chart right here, you could see every single candlestick represents a certain time frame. I like to use the daily time frame for almost all of my analysis, and even the bigger the time frame that you start, the better. So if you start with the weekly time frame, that's absolutely amazing. Then you go down to the daily time frame, but your setup should always be on the daily time frame. The reason why, and I tell this to every single new trader, is because on the smaller time frames, you can have a million different setups in the markets. There's so many stocks that are setting up on the smaller time frames all the time because the smaller time frames only take a few minutes to set up. But the daily time frames, these take weeks. These take days and even sometimes months and years to really set up a big pattern or a big base to trade. And imagine how many people are going to be having their eyes on these setups now. So these are going to be the setups that are going to make you the most money, especially with options trading. You want to be using momentum in the markets. Whenever there's momentum, whenever a stock breaks out of a big base, this is when you want to be buying them. So I always like to use the daily time frame for my analysis, and then go down to the smaller time frames to look at entries and be a little bit more precise. So this is a recent A+ setup that I took on the ticker Uber. I took the breakout right here as it broke the previous day's high, caught this two-day move right here, and it's probably going to continue to go higher. Now, what I did to figure out if this stock was setting up and if there was a good trade on it is I looked at the price action. You always want to look at the price action. You always want to get an understanding of what the stock is doing. So to understand price action, what we want to do is first look at the daily candles. So this is going to be on the daily time frame. The candles basically show us how the stock traded for the day. So for example, starting all the way at the bottom right here, you could see the stock made a move up. It closed right here. And then this day right here, it made a move up, but it closed all the way down here. So what red and green bars mean is where the candles closed. And the reason why this is so important is because not a lot of people understand, but the close of the candle is the most important part of the candle. The open does not matter. The close is the most important thing. If the stock had a very strong open, but closed all the way down at the lows, that candle is super, super weak. The close is the most important thing because it shows you who is overall in control throughout the whole candle and at the end. So what I look for is how candles close, meaning if a candle closes at the highs, that's super, super bullish. If a candle closes at the lows, now it's going to be a super bearish candle, and I'm probably going to be a little bit cautious or look to take things to the downside. So each candle will represent one day. Sometimes you'll have very thin candles. These are going to be candles that are kind of marking a little bit of indecision. They're called doji candles. So a candle like this would be a doji candle where you don't have much movement. You have a little bit of a long wick, another long wick, and then kind of like a equilibrium on the close and the open. These are going to mark indecision and basically tell you that the market is not sure if the stock should be going up or down. But when you get a break of that doji candle's high and low, that can make for an absolutely amazing breakout. And this is something that I utilize in my breakout strategy. The next thing you want to look for is compression within stocks. You want the stocks to be super compressed as they're making the moves and as you're entering the trade. The reason why is because we first have to understand how stocks even move in the first place. Stocks move in a pattern called a staircase pattern. So what happens is a stock will go up, it will then go sideways like this, then it will break out, and then it will go sideways again. And then it will break out, and then it will go sideways again until it potentially changes the trend. And then the same thing will happen on the way down. The reason why this happens is because stocks don't just go straight up and they don't just go straight down. This is why you never want to chase stocks. You never want to have FOMO because you're always going to get an opportunity to get into a trend if it's truly a strong trend. For example, this stock, that we drew out makes a move up, it goes sideways and then makes a move up. If you would have chased right here, you would have got pretty much burned. But if you would have entered right here as it's making its next leg up, you would have caught an absolutely beautiful leg up. You wouldn't have had much resistance and you would have had a really smooth sailing to the upside. Now, this is when we want to catch stocks within the market. We never want to catch them when they're extended. We never want to catch them too early within the pattern. We want to catch them right in the sweet spot as they're breaking out of these patterns and making really big moves in the market. So on the trade Uber here, you could see I actually took the trade right here as it broke this high. So this was a trade that I didn't chase. I waited for the setup to set up. I didn't just take it just because it was going up. It set up that staircase, that continuation pattern, then it made that next leg up. And now it's probably going to do the same thing. So you never want to chase stocks that are just going straight up because they're not going to go straight up forever. Sometimes they're going to set up, especially if they're strong stocks and they're going to continue to go up. You're always going to have time to get back into the stock. And this is what you need to look for. You need to look for compression within stocks. When a stock gets compressed, that's when the biggest moves happen in the market. Compression will always equal expansion within the markets. So always ask yourself, is there enough compression for the stock before I take the entry? If the answer is yes, you have a great entry. If the answer is no, you might be chasing the stock and it might be better to wait for it to set back up in a tight pattern. What I like to use is bull flag patterns. I like to use wedge patterns and I like to use pennants. In my opinion, these are the best patterns within the market, but all you need to have is just a tight consolidation within the market. It's not really as important what the pattern looks like. It's more so that there is a pattern because that will equal consolidation within the markets. Now, right here, analyzing the candles, you can see the stock Uber makes a move up. The candles start to become a little thin, meaning you're not getting a huge drive up. We're just kind of going sideways, which is exactly what we look for. Then you get a doji candle right here, and then you get another doji right here. And then you could see on the break of the doji's high is actually where the big move is starting. But we also have a hammer candle that was formed on this day right here, which is a candle that I use a lot within my trading. A hammer candle will basically signify that sellers are trapped and a big reversal is likely to occur. I usually like to use this for reversals or retests off of key levels. For example, right here, you could see the stock Uber retested right at this key level, which is the AEMA, this blue line, and then it made a big move off that spot, basically trapping shorts and squeezing the other way. So you could see on this stock HIMS, we have a hammer that gets formed right here, right into this key level. Then you have a big bounce up. This is how I like to use hammers for a reversal idea. If the stock is retesting a key level, if it forms a hammer, that's beautiful. That's exactly what we want to see. And then we can even combine volume. When volume is super high, that's telling us buyers are getting very aggressive, but we never want to blindly just buy a dip, right? We want to wait for high probability levels. We want to wait for high probability candles like a hammer candle to potentially set up to give us a potential big move up. So you can see right here, you have the hammer and then the move up occurs after that. Here's another example of a hammer candle that formed on the ticker HIMS. Right here, you have the hammer and then the rally formed after that big move from the hammer candle high break. Now, the next bullish candle that I like to look for is the bullish engulfing candle. This is going to be a candle that basically engulfs the previous day's body and wick. So you can see right here, you have a bullish engulfing candle. This is the previous day's high. This is the previous day's low. This candle completely engulfs the previous day, basically showing you that sellers are getting absolutely overpowered and there's a good chance you're going to have an absolutely massive move, which you could see ends up happening on this stock. I use this a lot for my entries as well, specifically on retests and continuation setups. When I see a bullish engulfing like this, usually gives me very good conviction that sellers are going to get squeezed out and buyers are in complete control. Now, just like you have a bullish engulfing, there's also a bearish engulfing candle. So a good example would be something like this. You could see this is the previous day's high and previous day's low. This candle completely engulfs it and it closes all the way at the lows, which is, again, remember the most important part. The candle needs to close all the way at the lows. That shows a big sign of bearish presence. Now, after that occurred, you could see the stock ends up making a big move down because that is obviously a super bearish candle. So bearish engulfings, bullish engulfings, similar. Obviously, the difference is going to be that bearish engulfings is going to be to the downside and bullish engulfings are going to be to the upside. Now, similar to the hammer, you could also have something called a shooting star candle. So this is basically like an inverse hammer. The only difference between an inverse hammer and this is that this actually closes all the way at the lows again, right? This is the most important thing. So shooting star candle will look something like this. It'll basically be the candle leaving over a very long wick. Your buyers are going to be trapped here and then sellers are going to take you all the way lower, close at the lows. This will usually kind of give you a big move down, basically exactly like a hammer candle. I like to use this for reversals. It also gives me an idea if the stock is going to continue to go higher or not. If I see a shooting star candle formed, usually there's a good chance they're going to get a move down. You can see the same thing happens right here, shooting star candle. That's usually where the high in the market is. Now, again, remember, the most important thing is going to be where the candle closes. If it closes all the way at the lows, that's super, super bearish. Now, in my opinion, the best way to trade is to swing trade momentum within the markets and trade breakouts. This is going to be when stocks are compressing within a very big level and then making a big move out of those spots. So a good example would be something like this on the ticker Tesla. You could see it go sideways after making the first move up. Remember, stocks don't just go straight up, they go in staircases. Then it breaks out and sets up another flag and then the big move occurs right there. You could see you have a lot of volume as the stock is breaking out and that's going to be your entry out of that spot. Now, a lot of people will always ask me, how do you confirm a breakout? How do you know it's not just going to go the other way? Well, the sad part about any single trading strategy is that nothing is always ever going to be 100%. If it was, every single person would make money and we would have a ton of trillionaires walking around the earth. But that's not the case because trading isn't just as easy as just buying any stock and having a 100% win rate. There's a few things you could do to make sure that you have a higher win rate on your breakouts. But just like any strategy, we need to have the proper risk management and we need to be able to accept losses because they are going to occur. Breakouts do fail and they fail often, but if you keep yourself in the right names in the leading sectors, this is going to make sure that the failure rate is going to be much lower than just trading any random stock. So the three things you could do to avoid a ton of failed breakouts is the first thing you want to do is trade leading stocks within the markets. This is going to be exactly what we just showed. Stocks that are having a theme, stocks that are super strong relative to the market, and stocks that are in a strong uptrend. Now, the next thing you're going to want to do is make sure the markets are trending higher. If the markets are trending higher and there's a lot of momentum, usually the stocks you're trading are going to have a lot of momentum as well. For example, when the S&P and the NASDAQ are on a bull run, a lot of stocks are moving up, specifically the stocks that are leading the markets higher. Now, the last thing, you want to make sure the stock gets a lot of volume when it's breaking out. If it doesn't have a lot of volume as it's breaking out, the breakout is probably going to fade and you're not going to have a big continuation move and solid follow through. So a perfect example would be in this example right here on Tesla. The market was starting to bottom. This had already made a move up. It was kind of leading the markets higher in a strong sector, technology sector. Then it broke out here with a ton of volume, and that's why I was able to make such a big move. The daily candle close is also going to be very important when you're looking at breakouts. If the stock closes all the way at the highs, that's super, super bullish. So for example, if the stock closes above the breakout level and closes at the highs, super bullish. If it's not able to do that, that's more than likely going to be a failed breakout. Here's an example of a failed breakout on the ticker Tesla. You could see right here was a nice breakout attempt on the stock on the daily time frame. It even had a little bit of volume as well. It just wasn't able to close above this level, which is the most important part. You could see it wasn't able to stay above. At the end of the day, sellers brought it down. It needs to close near the highs. If it doesn't close near the highs, it's not going to have a lot of momentum. But the good news is you just risk the low of day. We want to have a tight stop. We want to be able to accept that we're sometimes going to be wrong, because if we're not accepting that, we can get caught in a trap like this and we can lose a ton of money. Would you rather get caught in a trap like this, bag holding all the way down, or catch the next move after the reversal is finally confirmed? I would always rather just confirm the reversal, trade with the momentum of the market, trade with the trend, and that's going to make you a ton of money. A great example of how important candlesticks can be is the QQQ, which is the NASDAQ monthly candle. You could see on the NASDAQ, we had an absolutely massive hammer here in the month of April. That led to an absolutely huge reversal the following month in May, and probably going to lead to new highs within the market, all off of one candlestick. And you could have seen that the market was going to start reversing by looking at the bigger time frames and by looking at the candlesticks and kind of getting an idea of what the bigger time frames in the markets were doing. Now that we have an understanding on how to identify some of these really good setups, find compression within the markets, read some of these charts and read some of these candlesticks, we can start to use the trends of the market to really put these candlesticks and price action into use. You never want to use anything alone. You want to always have some sort of confirmation. You don't want to just buy patterns. If it was that easy, again, everyone would be able to do it. You want to make sure you have an edge over other traders. So your edge is going to be trading within the trend. A lot of traders don't trade within the trend. They try to fight the trend. They try to time the bottoms. They try to time the tops. But what if you could just trade the trend? You're going to make so much more money, because stocks at the end of the day are really designed to go up. You're betting on US innovation. You're betting on the markets going higher, and likely they are going to go higher as long as innovation is taking place within the US. So once you establish a strong trend within the markets, what I like to look for is using the moving average. So the easiest way to establish a trend within the markets is to use the exponential moving averages. These are going to be the average price over the last period of days. So what I like to use is the 8, 21, and 50 EMA. So that's going to be the 8-day average, the 21-day average, and the 50-day average. So this is going to give you a good idea on what the average price is. And basically, this is where institutions are usually buying and smart money is buying. The reason why this works so well is because smart money always wants to buy the average price, and stocks don't just go straight up. You always want to think of the moving averages as ammunition for continuation to whatever side the trend is. So for example, whenever stocks are above the moving averages like so the stock is above all these three lines, it's in a very strong uptrend. So every single time the stock retests that level, it's probably going to make a big move up. When stocks are below the moving averages, that's when you want to potentially be out of the markets or look to short stocks and play puts to the downside. Now, the best way to use the moving averages is to use them as an area of key levels. So basically think about it as rising support and resistance lines. So after the stock makes a big move up, remember what we said, the stock will build out a staircase like so, but using the moving averages, we can kind of even get a better idea on where the staircase will take place as long as the trend is super strong. So you can see right here, you have the staircase, the stock breaks out, and then it makes a big move up again. And that all happened right off these moving averages right here. So it gives you even more confirmation. It gives you even more conviction. Then again, the stock makes a move up, then it will go sideways, and then it will go up again. But you could see the whole time this line right here was bringing up buyers. Every single time it tapped it, it made a move up. Tapped it, it made a move up. So we don't want to just be blindly buying into the moving averages, but if we see a hammer like this or a hammer like this, that gives you better conviction that you can now buy stocks off the moving averages and you can actually utilize this potential moving average bounce. So continuing to see how the market is moving, the stock continues to go up, it goes sideways again, it forms that pattern that we look for. The moving averages are bringing up buyers, and then you can see we have multiple holds, but the best buy is right here as it's breaking out. That's where I like to buy the most. You could use the moving averages to buy if you see hammers, if you see bullish engulfings, but the best time to buy is when the stock is breaking out, specifically with a lot of volume. And then again, you could see the stock sets up in that pattern, makes a move up, breaks through the highs, and then you get an absolutely massive move until it finally starts to break the trend. So stocks can't just always continue to go up. Sometimes they're going to break the trend. Sometimes they're going to get under all the key moving averages, and then you start a potential downtrend like so, right? Until the stock is able to reclaim, then it starts to uptrend. So trends are always going to change, and that's why you want to make sure you're following the trend, because if you're just letting your bias take control, what's going to happen is you're not going to follow price. And at the end of the day, price is always the truth. Nothing else really matters much. Price is going to tell you what's right, and it's going to tell you what's wrong no matter what you think. So always follow price. Always be ready to react to what price is doing, and don't try to predict what's going to happen. Just react to the price action in front of you. This is what the best traders do, and this is how you actually make money trading stocks. So to wrap this all up, we're looking for big bases within the market, specifically wedges, bull flags, pennants, anything that tightens up a stock. And then we want to see the stock start to move above the moving averages. So like so, you could see the stock moves up, gets above the moving averages, and then it sets up in a tight pattern again. This is going to be your continuation setup. Then you could see it test the moving averages, it holds perfectly, and then it starts to go back up again. Now you have the big move up, you have the retest of the moving average, and then the stock goes up. You never want to chase the stock when it's just going straight up, because what's going to happen is eventually you're going to get caught, and then you're going to get a terrible entry, and you're going to lose a ton of money because the stock is going to pull back. But if stock is going to continue to go up, and if the markets are going to continue to go up, you're always going to have more setups. So what's going to happen is the stock will go sideways, it'll set up in some sort of flag again, and then you could trade it after breaking that key level. This is how you take the best entries and not chase stocks as you're making wild moves to the upside, and actually have confidence within your trading. Too many traders, they continue to chase stocks. They don't know exactly which stocks are going to continue to move up, or if they are going to continue to move up, and they're just gambling. But what if you could use an actual system that has a high win rate and high probability for your trades to actually work out while actually catching the best stocks within the market? This is exactly what this is, and exactly what I'm going to teach you throughout this whole series. So now that we found the setup and we have an idea of what we're going to trade, we're in a strong trend, we have a market leader, we need to actually figure out what options contracts to buy for the stock. So what I like to do is a method called measuring the move. So what that means is I'll go on tradingview.com, and then I'll actually measure the base length of how much the stock has consolidated. So for example, if I'm looking to trade this move right here, so this is a big weekly setup on the weekly time frame, the stock is making new all-time highs, it's breaking out. I need about 400 days. There's about 400 days of consolidation. What I usually like to do is divide that by 2. So that's at least how much time I'm going to need for the move to play out. So if there's about 400 days of consolidation, I need about 200 days on my expiration. I usually like to go about 6 months out if that's the case. Now, you can obviously take less time on this and go to like June 20 cons, which would be 1 month out, or 2 month out contracts. But the more time, the better when you have these big bases, because we're looking to actually catch a big continuation move. So if the stock has been setting up for 2 years, we can have an absolutely massive move. For example, you could actually see on the weekly time frame, Uber made a similar move about 2 years before this, and this would have taken at least 2 years to play out, or about a year to play out. So you wouldn't have really caught a lot of the move if you didn't have enough time on the contract. So you always want to be able to buy enough time to be able to hold for a long period of time. I usually like to go about 1 to 2 month outs. It's kind of like the sweet spot for me with options. If you go anywhere like farther out, you're not going to have as much leverage. So I like to always measure the base. If I'm looking, for example, to trade a smaller daily base, okay, now we could take some smaller time frame trade, and we could look at a shorter expiration. So this is about 10 days of consolidation. So we can take about 2 to 3 weeks on the contract to be able to get the move that's expected from this bull flag. So the next thing I actually like to do is use the next OPEX for my expiration. So for example, you could see a lot of brokers here will have the W. This is going to be for a weekly contract. This is going to mean that the contracts are basically going to be brand new every single month, meaning they don't have that much open interest and that much volume. The OPEX expirations is going to be the third Friday of each month. This is going to give you the highest open interest and the highest volume. And the reason why this is important is because you want a ton of liquidity for the stocks you're going to be trading, specifically the options, so you can get in and out of the contract super quickly. So I like to target the expirations that don't have a W. This means it's OPEX, which have the most liquidity. And I usually like to go the next OPEX out after about 2 weeks away from the OPEX, meaning right now the next OPEX out is going to be May 16th, but that's only 4 days away. So I'm probably not going to be trading this unless I'm taking a very small trade on the smaller time frames. So I'm going to be looking mainly at the June 20 calls. This is going to be the next OPEX. The reason why I use OPEX again is because it has a ton of liquidity. There's a lot of open interest and there's a lot of volume on these contracts usually. Once you chose the expiration, what I like to do is I like to choose the strike now. So what you want to do is use the ADR. The ADR is basically going to be the stock's average daily range. So right here, you could see the ADR on this stock in the top right corner is going to be 4%. I want to buy 4% out the money because I want to get a little bit of leverage. I don't want to be too deep in the money because then the stock is going to move. I don't want to be too deep in the money because then the option is going to move similarly to the stock because it's going to have a high delta. I don't want to choose strikes that are too deep in the money because I don't want the option to be moving like the stock with too high of a delta. I still want to take advantage of the leverage of the out the money options. So I like to take like the next strike or the strike after that out the money, but it's all depending on the ADR. So the ADR is 4% on the stock. So now what I would do is measure how far away 4% is on the stock. So right here, 4%, that would be about $92. So I usually like to do is take the strike that is around the ADR, which has the highest liquidity. So for example, you can see that you have the 90 strike, then you have the 92.5. These two fall perfectly under the strategy that we look for. So now we just have to pick and see which one has the best liquidity. So for example, right here, you can see the open interest on the 90 call is actually 23,000, whereas the open interest on the 92.5 is 2,000. So there's a huge liquidity difference in the 90 calls. This is why I'm going to choose these ones. So this is going to be the call that I choose. I'm going to be swinging this stock until it hits my target and hopefully it gets in the money. That's going to be a big boost to the contracts and it's going to absolutely pay if it does hit those targets on the big breakout. If you use this breakout strategy and your timing is spot on, your charting and your technical analysis understanding is spot on, you can make a ton of money. Over the last year, I've made over 7 figures just trading this strategy, and it's because I have the timing down, I use the right risk management, and I make sure that I'm only in the best setups in the market. This is why it's so important to be able to read price correctly, use the candlesticks, use price action, use trends. That's one of the most important things. You want to be in the market when there's a very strong trend. You don't want to be in the market when the trend is weak because then you're not going to be able to make exponential returns. So always start off with making sure the stock is in a leading sector. It's a strong sector in a strong trend. The markets are trending higher. Then you want to look for the setup within the price action, a compression move. The stock wants to be already in a strong trend and then set up in a continuation pattern or in a very tight flag or a bull flag, wedge, whatever these type of patterns that we talked about that we look for. And then we want to see some strong candlestick formations as well off the key moving averages, off key support and resistance levels. And then we could look for the stock to break out of those key levels for very strong moves. If this video gave you clarity, make sure to subscribe. This is only the first video out of 3. I'm just getting started with this series. In episode 2, I'm breaking down the most important tool that I use. This is going to be volume. We'll be going in depth into exactly how I find the best volume patterns and how I'm able to use volume to basically confirm all my breakout moves. See you in the next one.